Imagine making a logical trade, buying into a massive stock rally, only to watch the price plummet the exact second you enter your order. Or consider the opposite. You panic and sell an asset at its absolute lowest point, locking in your losses right before it violently bounces back into profit. This animated chart shows the poor problem. We're looking at a chaotic, jagged price line moving wildly across a blank grid without any framing. When you look at a market this way, without knowing its hidden boundaries, you're forced to treat every movement like a random, unpredictable event. But in the 1980s, a technical analyst named John Bollinger realized that market volatility follows a repeating cycle of storing and releasing energy. To capture this cycle, he created a tool called Bollinger Bands. Think of it as a dynamic map that adapts to the market's temperature in real time, widening when things get wild and contracting when the market quiets down. Applying this visual map offers a way to look past the immediate price action and identify the structural shifts that usually precede a major move. This chart shows a 20-period simple moving average, the smooth center line tracking the core trend. Next, we add two outer boundaries plotted 2 standard deviations away. This creates a mathematical containment zone, trapping 90% of all price action inside. That containment zone lets us read the market's breath. Over time, the outer bands pinch closely together, entering a contraction phase traders call the squeeze. During a squeeze, the market is in a tight consolidation phase, absorbing pressure and storing kinetic energy, exactly like a physical spring forced inward. Recognizing this period of low volatility, characterized by narrow bands, signals that an aggressive, high-volatility event is likely to follow. This candlestick chart reveals the trigger. A single green candle breaks through and closes entirely outside a tightly pinched upper Bollinger Band. That close outside the boundary provides a directional signal. Above the band indicates a bullish surge, below signals a bearish drop. In strong trends, the price walks the bands, continually touching the top boundary and pushing the expanding edge higher. Eventually, that momentum fades. The rally reaches exhaustion, and those outer bands act as dynamic ceilings in overbought territory or floors when oversold. When exhaustion hits, mean reversion takes over. Failing to break a band, the price detaches, falling back to rest on the middle average, acting as a statistical magnet. Tracking this lifespan, the initial squeeze, to the explosive breakout, and finally the reversion, gives you a systematic way to observe the release of energy and plan an exit before the pullback occurs. However, a simple touch of an outer band is not a guaranteed buy or sell signal on its own. Relying on the bands without secondary context leaves you vulnerable to head fakes, false breakouts that can trick you into a position just as the price reverses. For accuracy, use a split-screen layout. A Bollinger Band chart experiencing a breakout sits above a momentum indicator. Traders seek confirmation between them. A volume spike exactly as price breaks the upper band provides statistical evidence the move can sustain itself. Used in combination with these tools, Bollinger Bands offer a window into crowd psychology, revealing when the market is exhausted and when new energy is entering the system. Grounding your decisions in these measurable cycles allow you to move away from reacting to every market tick and toward a strategy defined by specific, observable data points. Start by applying Bollinger Bands to your favorite assets to see how they react at these boundaries. And if you're ready to refine your strategy further, join our expert trading community for weekly market insights delivered straight to your inbox.